Call 356-9397. Opinions and views expressed represent those of the guests and do not necessarily represent those of the station. And now, Paul Ruedi's On the Money.
Good morning, everybody. I'm Paul Ruedi with Paul Ruedi's On the Money radio show. Today, I promise it might be the only hour everybody gets that's non-political. So we're going to keep it that way. So maybe the only hour between now and late Thursday, so there's no politics involved, if we can keep it that way. I'm here with Dr. Fred Giertz. Dr. Fred, thanks for joining us today.
Right, good to be here.
And David Ruedi, certified financial planner professional and retirement income certified professional, joins us as well. And David, of course, is with us at Ruedi Wealth Management as well. David, good morning.
Good morning.
And we have financial advisor Ryan Repko, who also is with me at Ruedi Wealth Management. You can call Ryan. Good morning.
Good morning.
You can call in at 356-9397. Unless it's a political call, then you can't. Or text us at 351-5357 on the Castle Heating and Cooling text line. You can also email your question to talk@wdws.com. We want to invite all of those tuning in on Facebook Live. So we're using our OWL once again, our fancy pants video, 360 video. So you can go to Facebook Live if you'd like to see what the show actually looks like. It's important to recognize that past performance is not an is no indication of future results, and you should not make any investment decisions without first consulting your own financial advisor and conducting your own research and due diligence. Well, Fred, this is the easiest question you're going to get all week. Are they going to raise interest rates again this week?
Yes.
And that would be from 2 to 2.25%.
Right.
Is that correct?
So you would presume that this is all baked into the system that everyone expects at this point, so it shouldn't be any big shock. Again, it's actually good news. It shows the economy is doing well. Inflation's under control. Everything is good right now, which may be a little bit scary, but at least right now there's no particular problem. I'm not going ahead with that.
There seems to be a little bit of dissension creeping in as far as how aggressive they might be. Yeah. I suppose that's good and favorable, but still it looks like, look, if anything, we're going to have slow and steady rate increases, and people should expect that.
Now, the other argument is that if you don't raise rates, you don't have that particular tool in place in case we do have a recession in the future. So if you're down around zero, there's not much you can do. And if you're back up to a near normal range, you have more flexibility.
So they need to get those arrows back in the quiver, because they basically shot their last one in 2008, 2009, and after the fact even, they continued to do that. So yeah, I mean, everything seems to be coming up roses for the most part. On the way in, I was listening to a little bit of radio. Donald Trump was talking about, just all the facts. And now it seems like, well, again, I'm staying away from politics, but so, I mean, just from an economic standpoint, now we're at a 50-year low. It seems like last time we talked, we were at a 49-year low for unemployment or unemployment claims. And of course, it sounds like it's pretty well rounded, that everybody's participating. And
the kind of wild card is that we also have very low inflation at the same time. In the many years past, the situation where we had very low unemployment was accompanied by a lot of inflationary pressure, and we don't have that right now.
Yeah. So I'm going to go to a question on text. It's a good one. It's one that maybe a lot of firms wouldn't read because it has something to do with a client that called in, or a potential client, and I'll go to it in a minute, but just our minimum size. But I want to talk about that in a more generic sense and address the question when we get to it. But it does seem like here we have a stock market, Fred, at all-time highs, and of course that a lot of people would say, and it's always been suggested, that's looking out forward, maybe 6 months plus. So that would suggest that maybe for the near term, at least the next 6 months, maybe the expectations at least are that the economy will continue to be strong or remain strong, if not get stronger. And I think that seems reasonable.
Yeah, right. Everyone now is talking about not the next quarter, but maybe 6 months away, as you said, or more, as the first period where we have to actually be watchful. Now, again, you can sometimes be overconfident, but I think right now it's a strong situation.
Things can change, and we have very respectable returns for the broad U.S. class guys, probably up some 8 to 10% for the year. Again, within striking distance of all-time highs. Just a couple of days ago, I think on Friday, we were at an all-time high. We might have been down a little bit yesterday, but very little, if any, at all. So here we are hovering around there. Investors have to like that. We're going to talk about that versus a globally diversified portfolio, because international investing has been a bit of a drag on return. So for the diversified global investor, it's still a very nice year from a return standpoint, but not near as good as just someone who, for instance, bought a Standard & Poor's 500 index. And Dave, you wrote a blog on that we're going to get to. So that's certainly, people may be hearing this, but if they're more broadly diversified, they may, they say, well, I'm not up 8 or 9%. Maybe I'm up 4 or 5, 6%. But still respectable gains. And, with all these interest rate increases, we're seeing that. And we leave very little. It's rare that we have much money in money market fund guys. Usually it's ahead of somebody needing the money here in the next very short term period. But, we've gone from a money market rates now that soon will be above 2% per year. And what a change that is in the last year when they were essentially earning nothing. And so for investors that are buying CDs and things like that, about every couple of months, they see their interest rates go up 0.25%, which is why a lot of people are keeping their investments short term. And certainly that's something we've managed to do. I was reading an article from Ken Langone. He's the co-founder, Fred, of Home Depot. Just as an aside, he says he couldn't, if it was today, he couldn't start Home Depot again. Maybe now, because he did mention in what I'm about to talk about in his talk, that the regulatory environment is, in his word, well, I don't want to say his words, because my takeaway was, if I had to paraphrase, was that there's been so much regulatory relief that essentially it's released the animal spirits, and he's seeing a boom. He even said that they have a truck division, I guess, that they lease out trucks, and he said we can't get new trucks until next spring to lease out. So, is it? Wonder, that makes me wonder, is that just a tightness in the pipeline? I mean, I
think so. And also, firms probably don't want to overexpand. They're a little careful on the upside as well as the downside. So you might not want to build a new plant now to make up for the backlog of trucks. But I'm sure that he has his ways and means of getting trucks if he really.
Well, I suppose it's probably logistics.
He also, parenthetically, is still doing well. They just announced that the NYU Medical School is no longer charging tuition. It's because of Ken Langone.
It's been a good business to him. He said every indicator for the moment is showing a clear path for economic growth. Would you agree with that, or is there some areas that?
There's always a fly in the ointment, and the trade situation is still a little bit worrisome. Some people have said it's not as big a deal as,
including him.
We've been thinking about that, because the ultimate goal is not to have these continue forever, but to make some kind of deal. So I think that, again, that's the one stumbling block, but so far we've overcome that.
Well, you billionaires think alike, Fred, because Langone also agrees with Jason. CEO Jamie Dimon, who told CNBC interview that the escalating U.S.-China trade dispute is a skirmish rather than a trade war. He says Jamie is right, referring to Jamie Dimon, who again is the CEO of J.P. Morgan. It's a skirmish. It's a tactic, Langone said. It's our mutual interest to fix it. China is better off with a revised deal than no deal. So it does seem to be that strategy of, okay, let's see who can go through the most pain in the short run. And I've always had this, and I could be dead wrong, but it seems like such a controlled economy in China, and there's so many hundreds of millions of people always at the doorstep of marginally ready for unrest, that I think they have I really don't know, but my sense of, just from all the reading, and I read 2 or 3 hours a day, that there's a lot more pressure, I think, on the Chinese to get something fixed.
But it's also, I think, a little worrisome. The Bob Woodward books suggest that Trump has been deterred by his advisors from doing these things, and as he gets rid of more and more advisors, maybe there'll be less.
Maybe we could actually go from a skirmish to a trade war.
Yeah.
Oh, wouldn't that be lovely?
Sorry to get into politics, but
that's why I always like to have Fred. Here's that, that rosy cloud there. So, no, you are an optimist. I know that. We're gonna let's take the text, guys, and talk about this. And again, the easiest thing for me to do is to try to sidestep it and not address it. But it's the text. It's from Mike in Champaign. It says, and I'm going to move my microphone if you hear a little. Hello, Ruedi, guys. I recently sent a message to the company, and referring to our company, I'm sure, asking about what it takes for someone to help me do some planning. To make it short, I was told if I didn't have $500,000 in assets, your company wouldn't be interested in being an advisor. Well, we wouldn't. We certainly didn't say it that way, and I think Mike would agree. I think that's his paraphrasing, and we'll get to our business model. And part of that dilemma that some firms are talking about, we always have to have a mechanism so everybody can be served with good financial planning. And part of the skirmishes that are going on in the regulatory area, some are suggesting it's going to make it harder for people with lesser sums of money. It's a lot of money to them, but with lesser sums to get that financial advice. So I'll go on with the question. Can I ask why? Is it because you wouldn't earn enough from me to profit? I'm not criticizing. I'm just wondering why someone needs to be that rich for help. Would it be fair to say the people at Ruedi Wealth don't care much for the middle class? See, I told you I shouldn't read this, but I like to be transparent, and right. I don't think it's anything we need to run from. We're going to discuss it. I think it will make sense to people. Would it be fair? Don't care much for the middle class? So, well, considering we are the middle class, I don't think we're guilty of that. But I understand where he's coming from. Just so we're aware, there are probably more of those people listening in the radio show than the really rich. 500,000 is a very high level for most to qualify, Mike and Champaign. So let's talk about this, though. I bet if we had an agent, they'd say not to. But this is something that we speak about in the company all the time. I've never had in my 35 years until the last year, I've had no minimum requirements to become a client. Now, any business coach in America will tell you that if you want to be a profitable financial planning and investment advisory firm, you're going to have some type of threshold. Otherwise, you'll end up trying to serve so many people that you'll serve nobody. I mean, that's kind of my sense of it. You can't be all things to all people or most things to most people. So we kind of have a niche, and you kind of have set up. Ryan, did you have something you wanted to? Okay. Yeah. I thought you were pointing.
Yeah. What I was going to say is just addressing the question head on. It's something that we actually wrestled with internally. Like, is this something we want to do? And I think we kind of came to the decision that it was something we had to do out of no choice, simply because there's only so much bandwidth all of us have. And when it comes down to making sure that you're running a business that is not a nonprofit, which we are not a nonprofit, you have to make sure that you don't come out in the red. And I think for us, it was a real pull at our heartstrings, thinking that here we are trying to segregate ourselves from people. Really, it was just coming down to a simple decision that as a business, we have to keep moving forward, but we can still help people on the way, giving free advice to folks, even if they don't meet our minimums.
I think that's key. That's kind of where I was headed next. Usually the approach is, and really, Mike and anybody listening to this, we really do sit around and try to figure this out. And most, if we hired a business coach, they would tell us to make it $1 million or $2 million. But I'm not comfortable doing that. We try to help anybody that needs help and wants help. So would it be fair, David and Ryan, to say that if we find out that it's a relationship, it really comes down to we can only add so much value in a person's life, and we want to make sure for sort of our minimum fee that the people are going to get a fair shake and a fair deal for us to run our business model. So that kind of forced us there. But I think it's every time we try to help at some level, and then it becomes pro bono. In other words, and I've heard David do it, I've heard Ryan do it, you guys have heard me do it, spend a half hour or 45 minutes on the phone with somebody, discussing their situation and giving them directionally, because many times it's an acute issue, an approach. And generally we'll even be as specific as to say, look, it doesn't sound like your issue is really all that complicated. You could do something as simple as going to Vanguard yourself, save our fee, save yourself some money, because maybe it's not an issue where it requires full-time planning like most of our clients do, and even point them in the right direction from an investment standpoint, and tell them, look, as long as you quit listening to financial people for the most part and stay away from people that sell products, and if you go to Vanguard and do something as simple as maybe buying the Vanguard Balanced Index Fund, and spend maybe 3 to 4% a year from that, increase a little bit each year. So we always go out of our way, Mike, and I think David did that in this case, to really try to give people help, even if it takes an hour out of our day pro bono to get those people pointed in the right direction. I wish there was a solution, guys. And David, last week we had this, we talked about, is there a solution we're missing where we could help people that don't have $500,000 or so, and we scratch our heads and we think about it. I've thought about hiring one more young person that just dealt with small accounts, but we are in a heavily regulated environment, and that's just one more. So a lot of this gets down to practical business things. Dave, I think you have something you want to.
Yeah, I think the first thing to just say, like Ryan said, basically directly is there's a cost to running a business, and you have to have a certain amount of revenue for each client just to offset the cost of taking on that client and make sure that you're profitable so that you can stay in business and help people at all. Because if you don't do that, then eventually you're going to go out of business and you're going to help no one. So then the question is, or really the key issue is, what is our target client? What do they look like? And what is our pricing structure? So in other words, how are we going to get paid
Right.
at least enough to make enough profit to be a sustainable business? And for us, our target clientele is retirees. And retirees tend to have, in order to retire, you have to have a pretty big level of assets built up to help support your lifestyle if you don't have a big pension or something like that.
Sure.
And not only that, they're decumulating from their portfolio. So their portfolio is going to be shrinking over time. And we're charging a fee on the assets under management. So for us to basically set our minimum price at a level that allows us to be profitable, we have to set a minimum asset level. So there are alternatives to that. But either way, someone's going to get paid. So that's kind of my breakthrough was, well, there are other businesses out there that specifically target clients that have lower asset levels.
And we'll talk a little bit about some of those because I want to take a call in a minute. We'll go back to this. So let's drop a die marker there. Maybe this call will be related to this. Maybe it won't. But I want to go over some of the suggestions we make, including like Vanguard that has their personal portfolio management for 0.3%, which for many people is going to work. Again, we have no affiliation with Vanguard. We have no reason to. No conflicts of interest or reasons. There's no quid pro quo. They don't know we exist. And we continue, as people who listen to the show know. And one other comment I make is doing this show alone, which takes a lot of our time to prepare for the show, to do the show. It takes time out of our month and days and weeks to prepare for the show. I like to think, I hope that this show is our way of saying, look, not everybody has the financial wherewithal to hire a financial planner that may have a minimum. What we've tried to do for almost 30 years now on this show is give people the right questions to ask, give them ideas of where they might go to seek that help, such as Vanguard personal portfolio management for a very low cost. There are investments that are very low cost. It's not unusual for, so I like to think that this is our way of serving everybody that needs help, not just people with 500,000 or more. And so I like to at least bring that up. So Rob has certainly been patient. Rob, thanks for calling. Paul Ruedi's on the money.
Hey, good morning. You just stole my thunder.
I did?
Yeah, you guys have a vehicle. It's called This Show for people with less than $500,000 or thereabouts. You helped me tremendously over the years, and I appreciate that. And just want to remind you I'm assuming that's what this show is all about, aside from just helping other people to realize you guys have a service that's worth using. But for folks that cannot meet the threshold, we, myself included, have gotten tremendous help from your program.
Well, it's kind of you to say that. It's very kind, and we appreciate that very much. Anything else, Rob?
Thanks. That's it.
All right. Thanks for calling, Rob. Yes,
I was going to sort of reiterate what you were saying, that basically there's a fixed cost involved of doing a financial plan, whether you're $200,000 or $1 million,
right.
And the fixed cost is fairly substantial. And you could go to a time-based charge system, which you probably don't want to do. And the other thing, which you mentioned, and we talk about more broadly, I think you usually don't have a lot of good things to say about robo-advising, but if someone's in this beginning category and wants to get up to that $500,000 threshold, a far-out target date fund with a robo-advisor is probably a way to get you to the place where you can move into this category.
And there's a number of choices there that you can pay as little as maybe 0.25% or less for that service. Dave and I discussed that just last week. We're saying, well, we want to go there and say, yes, it is a great service. But then on the other hand, we're talking about allocation. And if they could get someone to guide them, then they can go directly to Vanguard and kind of get to the same place. But you're right. There is more and more choices. But for people that want a comprehensive, that really, I think, when people hear, and again, I'm transcending politics, I hope, it's a highly regulated business. I mean, the cost to be in the business we're in now compared to 10 years ago, it's incredible. Everything we do has to be archived. So it probably costs us 10 or 15,000 a year just to archive our blogs and our emails. I mean, things that probably are sensible and you should do, but the cost structure to be in such a regulated business. And I'm not arguing against the regulation. I think some of them probably I don't agree with, but for the most part, you get swept, even though we're, I would consider ourselves a small firm. We manage around $250 million for people in town. I think that's a lot of money, but compared to a lot of folks around the country, we're not that big. But we get swept into the same cost that the multi-billion-dollar firms get. So, anybody have anything else?
Well, I think
go ahead.
Again, I'm not a financial advisor, but if you're talking to a young person starting out, I think you could tell them in maybe a minute. First of all, use your 401k, 403b as much as possible. Save as much as you can, and put a lot into equities and invest passively at low cost. And wait until you get to this threshold.
That's a great point, Fred. And there's nothing we really enjoy more. If I get a couple that walks in, a young couple in their 20s, 30s, 40s, it keeps expanding as I get older. Now it's 40s, young people. There is nothing I like to do more for no cost than to spend an hour with those folks that are really trying to be good stewards of their money for their family. And a lot of it is what you said, and probably an equal amount is mistake proofing. We tend to we don't talk much about mistake proofing, but if you can give a young couple the guidance early on and talk about, here's the 3 or 4 big mistakes most people in your position will make. Don't do these things. If you feel like you're going to do them, call us. We'll talk you out of it. And, we'll spend 5 or 10 minutes on the phone. So I understand Mike's, this, when they were trying to, in the last couple of years, they were trying to pass the fiduciary rule. Well, anybody dealing with retirement money, whether 401ks, IRAs, 403b plans, anything associated with a retirement type plan, they were trying to pass a regulation that you had to, get this, guys, put the client's interest first, ahead of yours, ahead of your firm's. I mean, it seems like common sense. Since then, of course, we've had firms, major brokerage firms and insurance companies lobbying against their own clients for that. It doesn't make sense to me why they would lobby against their own clients in order to just make more profits for themselves. But the whole point is, part of that discussion was, where's that going to leave the people with smaller balances? And unfortunately, many times they're left to the sales, the product end of the business. Now, there's nothing inherently just wrong with that, but we see more problems walking through our door that comes out of that environment instead of the fiduciary base, put the client's interest first base. And that is a concern of mine.
Yeah, and I think something that we should probably talk about is, what are the options that people have available to them aside from just robo-advisors? So
what do you tell people when they call and you have to give them that, which, again, look, my dad ran a clothing store and raised 5 boys. Talk about, we used to look up to the middle class people. So I didn't raise my kids to be that way, and Ryan wasn't raised to be that way. So we really do try to help. So when they do call, David, what's that conversation like?
Well, I think the first thing is, a lot of times people with lower asset levels are younger people, and they have very simple needs. And especially if they're just looking for investment advice, I tell them, look, you probably shouldn't be paying a financial advisor 1% of your assets just to build an investment portfolio for you anyways. Right. In fact, you can go straight to Vanguard and say that it's a young person. You can buy one fund, the Vanguard Total World Stock ETF, and call it a day.
Which is an exchange traded fund. It's much like a mutual fund, but when we use those, I like to back up a little bit.
Yep. Basically the same thing, a little different wrapper. And the reason I recommend that to young people is it's free to trade if you have an account at Vanguard. So that's kind of option number one, is just do it yourself. Things can be really simple when you're young.
And you can point them in the right direction, even right down to, here's the fund that you buy. It might be that fund. And as Fred said, if you can do that, along with, don't buy whole life insurance, just buy term insurance and buy more than you probably think you need. Don't take a variable rate mortgage. Take a fixed mortgage and put the interest rate risk on somebody else. Don't buy more house. Just because you can make the payments doesn't mean you can afford it. and give them a sense of what the difference between affording something and the ability to pay for it. Those are two different things. Don't invest in bonds in your 20s, 30s, and 40s for the most part. I'm broad brushing here. So don't, and this is not advice for anybody who's listening to this to say, well, Paul just said I'm in my 40s, I shouldn't buy bonds. That's not what I'm saying. But so I'm taking I'm taking the ability to paint in broad brushes here. And by the time that person gets off the phone or comes in to see us, and it's not that we won't visit with them, they just drank out of a fire hose of financial education, and where our nature is very protective. I think to a person in our firm, I almost said to a man, but would that cause a problem? Because Rose, who works for us, of course, she's my sister-in-law, and my wife works for the firm, so there's females there. We're very protective, and I've noticed that with watching you guys too, your conversations are as much about here's 3 or 4 things not to do, along with here's the 1 or 2 or 3, as Fred said. And make sure you pick up 100% of your match in your 401k or 403b plan. Don't take on a lot of consumer debt. Don't invest, your 401k money when you're trying to accumulate wealth in bonds. Put it 100% in stocks or as close as you can stand. Along with that mistake proofing. We do have a couple calls that have been waiting, and we can always go back to this. It seems to strike an interest. We're going to go to Mark on line 1. Mark, thanks for calling Paul Ruedi's On the Money.
Thank you, guys. Enjoyed your shows each time they're on, and do not disagree. In fact, agree with what you guys are saying, and you guys are covering it quite well. But you said 250 million is roughly what you're under management. So your fees, I'm assuming, are 1%. I don't know. I would say, and I don't know how many employees you have and how many you're trying to feed and various things, but that'd be pretty good in Champaign-Urbana, wouldn't it? Getting $2.5 million for
Well, you're making an assumption that that's our 1% fee. We have some.
I am.
We have some.
Correct?
You're right, and you admitted it. We have some very large accounts that are part of that. We have some very large accounts. So, the fees can. I'm not get into our business with it, but I would agree. I wish we were getting 1% on every one of those assets. And again, approximately 250 million. That's another regulatory issue. I haven't looked in the last few days. We were at 247 million. I don't know. So please,
it's lower than that right now.
Okay,
a little bit.
Just slightly lower than that. So
you knew the sun would know, right?
Well, yes, you knew the sun. Mark would know. So they look at it.
David would know.
Yeah. David would know for sure. So it's a nice business. Well, don't get me wrong. We've been very fortunate. We were just recently chosen as the People's Choice Award winner. We've had some good wind behind our back. The kids have really added nicely. It's a great family. Spoken like a true father. We all get along. We have our own roles. It's a profitable business. Everybody makes a decent living. You don't see any. I'm still driving my 2007 Chevy Suburban with 204,000 miles on it. Dave, you're still driving an old car. Ryan, you drive an old. So, we're kind of gotten to be a pretty frugal bunch, but thank you. We have a very nice business because we've been blessed by the show, the ability to have this show and to expose people to how we think, how we protect people or try to protect people. We really think we hope it's a service to the community. And because of that, let's face it, it's been very good to us as well. We have
I just want to bring a little bit of maybe a balance. That's all.
Yes, sir. I'm glad you did.
Or anything.
Oh, no. I appreciate that. And it's a good observation.
Well, and I think
Thank you.
Thanks, Mark.
It actually brings up another important kind of consideration that I thought through during our conversations about implementing an asset minimum. And one of those is if you look at an advisory firm, if you run it right, it can be a pretty high margin type business. And what that means is that, especially if you have a good number of clients that are paying you large fee revenue amounts, then you can afford to take on some that are frankly just not profitable. You're literally taking a loss on those, but you have enough revenue to offset that because of some of the people that are paying you larger fees.
Right.
The question to me is that really fair? So we have one person that's taking up an equal amount of time that we're losing money on, and he's taking time away from that person that's paying us a much larger fee revenue. And for me, it's, look, we need to make sure that we're not disserving our current clients who are paying us a handsome fee and taking on clients that just aren't as profitable and will ultimately, we only have so many hours in the day, take time and attention away from their account.
And would it be fair to say that we talk about this at least monthly and looking for a solution in-house? Again, I've thrown it out to the guys. Why don't we find some young certified financial planner that doesn't have views of wanting to own part of the company, because it's a family company. And there's all kinds, every employee you hire, ask anybody that hires a firm. With each employee comes a new set of problems and costs and, potential risk to your business if you say the wrong thing. And if anybody knows me, they know I'm always one comment away from losing my company. I'm trying to be better now that I'm older. So this is a real dilemma, and thanks for people indulging us and let us answer the question that was given to us by Mike. And hopefully it's helpful. And I'd like to add that we still are glad to take phone calls and help anybody we can and point them in the right direction. Doesn't mean we're not going to talk to you. It just means we probably just aren't going to be able to justify the value proposition if you have less than $500,000. So it's fair to say.
And I think to end on a really practical, beneficial note for the listeners who maybe they just, for whatever reason, really want a financial advisor. They don't want to do things on their own, but they don't have a high level of assets built up yet. There are options out there for you. So one is there are financial advisors who charge hourly financial planning fees. So if you really need financial planning, not just investment management, you can Google search hourly financial planner. There are good financial planners out there, even in the state of Illinois that I know of,
right,
that do that. There's a firm in town that I'm pretty confident charges an income-based fee. So if you're, if you don't have assets built up, but you have a job and you have an income, then you can charge. It's basically a flat.
I think you're going to find that those are still, you have to be what some would consider beyond middle class, maybe.
And then there's a kind of more up and coming option, and it's more geared towards younger people, but frankly, the advice could be given to anyone. Sure. Is there's a group of financial advisors called the XY Planning Network, and they, by like the rules of the group are that you have to offer a monthly retainer fee option. So it's kind of like if you pay, $100 a month for your cable bill, you just have another $100 a month payment for your financial advisor. So there are great options out there. And then the last one is Vanguard Advisor Services. So that's an asset-based fee. And they have, I believe it's a $50,000 minimum, but that's lower than.
And there's a national firm, Edelman Financial. I don't like to do commercials for other people, and I'm not endorsing them, but I'm talking about options, and it's a reasonable option. I think they philosophically, from an investment standpoint, would align themselves with, we'd be aligned with them.
Right.
I think they have a $5,000 minimum. Now you might pay 2% fee, but that's $100 a year, and you get to talk to an advisor. So there are options out there.
Right.
Unfortunately, we just can't be all things to all people or most things to most people. I think it's a good conversation. I'm glad Mike asked the question. I'm glad we covered it. I mean, again, the easiest thing for me to do is just to ignore that text and not, lay out kind of a little bit about our business model that probably most people might not be interested in. But we're going to go. Jim's been so good for hanging in there. Jim, thanks for hanging on for Paul Ruedi's On the Money. How can we help you?
Well, Paul, I just want to thank you because years ago I came in, I had 2 accounts, and I wanted to separate. I wanted to have you take one, and you wouldn't. You said you had to have all of them, and I didn't appreciate that at the time, but I accepted it, and you were very nice, and you told me things that would possibly be good investments, which turned out to be excellent, which one was Vanguard. So I want to thank you because you really helped me.
Well, thank you.
Thank you very much.
It's nice of you to call in and say that. There's no but, but you're a fathead, Paul. So,
I didn't say that.
Okay. Well, thank you so much for sharing that, and we appreciate it. And again, I think that, and thanks, Jim. And I think, guys, that's at least demonstrates, hopefully, and trust me, folks, none of those calls, we don't know, those calls were not planned. We didn't even know this text was coming in today. That conversation, by the way, was interesting. That was not it more than met our required minimum account value at the time. That was more of my philosophically principled idea that people, if they're going to have an advisor, should have one. A person that has 2 advisors, I've never seen that work well for a family or an investor. And so, I always go back to, Eisenhower when he said, I'll fight the whole war or none of it. So that was more of my willingness to let a substantial sum of money that I would have been paid each year for many years, just because I won't do anything that disturbs the client. And I felt like if I participate in that, I'm really going against my principles. And as much as I would have loved to have that income stream, I felt it was in that client's best interest to choose one. And I remember my comment was, you already have an advisor. Why are we having this conversation? And that was my not trying to be cute way of saying, hey, look, you got your person. Go to that person.
You also end up in a kind of strange situation where you have to figure out what the other advisor is doing and
of
then
course
defend against what they're doing. So that does make sense to have two people basically operating against each other.
That is certainly one of the things that is one of the actual issues that when I say this serves the client, I've never, and the other side of that coin is I could say it's almost true to most firms that might be the other party is probably going to be less diversified than we are. From my experience, to the extent we're in stock market and the great companies of America and the world, we're going to be in 12 or 13,000 companies. That's not the typical strategy. And so what happens is now you end up with one advisor that may be non-diversified. And I'm not saying that's negative. I'm just talking about it's just a less diversified strategy. And ours is massively diversified. And this is the story I tell anybody in this position. I can promise you that over the next 3 to 5 years, one of us is going to do a lot better than the other. And you're going to mistakenly, in my opinion, and maybe it's me. And then you're going to assume that I'm smarter than the other person, and you're going to take the money from them and give it to me, probably when it's going to turn around and go a different direction. And so that's when I get into this. I just don't think it serves clients. I think it disserves them. And it doesn't make me right. I have a very strong belief that you hire one advisor and pick the right one. You'd be really careful when you pick an advisor. Anything else on this issue, Guy? I think we worked it over pretty well.
We talked about last night. It's the same variation of, I just inherited $100,000. What should I do with it?
Yes.
And the answer is, I can't tell you unless I look at everything.
Right. Really no decision. That's a great point, Fred. And David's come to me and Ryan has, and hey, how are we going to handle this? And, I'm frequently saying, look, the only way to make that decision is in the backdrop of a financial plan, because trying to do it in a silo is probably not going to be the optimal solution. So it always has to be, well, what if I spend an extra $50,000 this year? Well, I don't know. Let me run it in the plan. Let me pull it out and see what it does to your overall life plan. Or what would it do if I inherit $200,000? How should I invest it? It's going to be let's put it in the backdrop of the current plan. Let's see if we need to change the plan based on this. Maybe change the allocation. Maybe we move up the retirement. It could be a lot of things. And that's where it kind of circles back, Fred, to what we do is a very active role in people's lives, because I haven't met anybody yet, if you live long enough, that every few years something is not happening in their life. We call them curveballs. Sometimes they're good curveballs. Sometimes they're not so good. It's rare that a plan from day one stays the same. Even a year or two later, there's going to be modifications to the plan. Hopefully most of them are positive, and the negative ones hopefully are modestly negative and temporary. And so we play and I think any good financial advisor does. So it's not just us, but an excellent investment advisor and financial planner and retirement planner is going to spend a lot more time doing shadow work than you recognize that they're doing. It's not just that 1 or 2 hours that you meet with an advisor a year. There may be 5 to 10 to 15 hours behind that doing a lot of stuff that people just don't see. And that circles back to David's point that we have a business model, and all circles back to that business model. And how do we serve our current clients the best? So I think I probably beat that up plenty. But thanks, Mike, for the observation. We're sorry we couldn't at least have you become a client. I'm sure we're a delightful person. David, you wrote a blog, What to Expect While Investing. Now we have about 12, 13, 14 minutes. And we might just start on this today because I think it's very important. Because we talk a lot about, for example, we might say you can just buy the Vanguard U.S. Total Market Index Fund as an example to consider. Now it might be the Fidelity Total Market Index Fund because there's actually no cost at all. But again, it's really no significant difference. And that's probably default. And I've probably said that 100 times in the show. The default investment position from a stock market standpoint should probably be that. But that's not the same thing as me saying, but that's what everybody should do. And we've obviously over the years, and it's been consistent, I've this way since 1990, about the time we started this show. have taken a global approach. And so, in other words, we build what would be considered an unconventional strategy, and not unconventional. I mean, it's all based on good evidence that says, look, well, first of all, from a diversification standpoint, it makes sense. But when we look at these other factors that we invest in, like value and small companies, there's a lot of evidence that say, well, if you're going to move from that total U.S. stock market position, which should be the default, you should have an expectation that it's sensible and you're going to earn a premium return to do that. At least that should be an expectation. But sometimes the unconventional portfolio doesn't do as well as the conventional, just buy the Vanguard S&P 500 or the total U.S. stock market index fund. And I think your blog had a lot to do with that, and saying, well, what does it take to be a successful investor when you're going through periods like this that stir up emotions? One of the first things you put on the blog was, what was the first expectation? Sorry. People should have, it would be expect temporary declines. That just sounds obvious. Well, why even bring it out?
Well, it may be more than, I think people understand that there are going to be declines, but I don't know that they understand the true magnitude that declines can have, and also the normal frequency of them. So I tried to kind of put a little bit of color to that. So the first thing I mentioned was just the statistic that a correction, which is defined as a decline of more than 10% in the stock market, they happen on average every single year.
Right.
I think the actual data is like the average intra-year decline is somewhere around 14%.
It is, yes.
So if you're going to be a stock investor, you need to be prepared to see your money drop 10 to 14% every single year.
Like a crosstown bus.
And that's not saying it will happen every single year, but it's saying typically it happens on average about once a year.
That'd be like saying, look, Januaries are cold, right, in Illinois.
Right.
Yeah, that's kind of what you should expect.
So it's like you just need to be ready for that. And then I think what causes more problems than those corrections are what people call bear markets. And bear market is really just a term that we use to basically refer to a big market decline. The technical definition is greater than 20%, but they average about 30%. And as far as frequency goes for those, if you just look historically, they've happened on average about every 5 years or so. And again, that's on average. So there have been times where they hit closer together than that and times where it goes longer in between bear markets. But that's a pretty frequent kind of level to be experiencing basically a third of your portfolio
Seemingly
disappear. And, you know, my takeaway, first of all, was, one, this can be really scary. Two, it's natural to want to try to avoid these things. So you say, okay, well, these are pretty scary. What can I do to predict these and basically get out in advance so that I don't have to sit through them? And that is a fool's errand. I've never seen anyone do it consistently. Usually, even if people get out at the right time, they get stuck on the sidelines too long. And so my warning to readers of the blog was, instead of trying to predict these things, just know that they're going to happen. They're going to happen regularly. And when you have that expectation, you have realistic expectations, and you're not surprised by them, you're a lot less likely to panic and sell when they do happen.
And what do you think about the periods where you go an extended period of time where you're seemingly making no progress, where all you're doing is treading water, or you're kind of there, maybe giving you little paper cuts over a 10, 12 month, 2 year period? I mean, those can be from being able to stick to your planning. I think might even be more, because there's at least enough people that recognize, well, if my $100,000 stock portfolio is only worth $80,000 temporarily, I'm not going to sell, because I know that there's enough people kind of, I think, learning that. I'm not so sure that's true about the patience factor, the faith, patience, and discipline factor during extended periods of going nowhere. It's almost like it's not interest, folks. It doesn't get paid every quarter. You earn your returns in a lumpy fashion. But isn't that one of the more difficult challenges that investors experience?
I think so. And I think people don't realize how long those periods can be. So the most recent and most popular example that people will use is what's called the lost decade. And that's really based on one asset class, the 500 largest companies in the US. But if you look at the performance of the Standard & Poor's 500 between, it was essentially the beginning of 2000 to the end of 2009, your money would have actually declined about
Right.
10%. That's an entire decade
Right.
where you were treading water. Now, obviously,
With
like
two
I said,
50% declines in between.
yep, that's one asset class, and globally diversified investors fared better. But that the principle still holds.
Right.
There can be several year periods where you're essentially earning no return on the stock portion of your portfolio.
Yeah, I came into investing in it around 1970, so I had 12 years of
You know what the grind is.
But I didn't have the faith in either. I was sort of not knowing what happened. I was at a loss to know what to do.
And really, even we go back to that period, it's 1970. That's really for the first time when a lot of the data was coming out as to what to expect from expected return,
Yeah.
wasn't it?
Well, yeah, it was before. I'm sure people were talking about passive investment and that kind of stuff, but it wasn't really
But it wasn't
in vogue yet.
Didn't Ibbotson and Sinkfield do
Right.
their stocks, bonds, bills, and inflation? Didn't they? They started
Right.
somewhere around 1970, and
Right.
really prior to that, there wasn't this universal idea that stocks even earned more than bonds.
No.
You know, because the computer power hadn't caught up.
Actually, there was a story in the Wall Street Journal, in Newsweek. Paul Samuelson, who was probably the most famous economist of the second half of the 20th century, wrote a weekly column or biweekly column, and he said, "I've invested in TIA Craft I put half my money into the bonds and half into the equities, and after 10 years, they're both the same."
Yeah, yeah,
So in those days, it didn't seem like it was a big choice between equity and bonds.
yeah. And a lot of people just treated them as almost they were the same, and they didn't really expect that stocks would have that much better of a return. And of course, given you give it decades beyond that, you realize there's this massive difference. And that was part of your blog. You even talk about what the rewards are for this patience, but how difficult that patience is when it seemingly, could cause people to question whether their strategy is defective or not. Isn't that right? I think so. You wrote, Dave, that expect performance to differ from common benchmarks. It kind of ties back into that from an expectation standpoint. What are you getting at there?
So this is what you were touching on when you first introduced the article, but anytime you're a diversified investor, your performance is going to differ from the benchmarks you see on TV.
By design, right?
And for whatever reason, people always, if they ask, oh, what did the market do today? They're going to turn on CNBC and they're going to look at either the Dow Jones Industrial Average, which is it's more or less the 30 biggest companies in the US, something like that. And the Standard & Poor's 500 index, which is essentially the 500 biggest companies in the US. That's really one asset class. That's
the largest
US
more
companies.
growth-oriented companies.
Exactly. So first of all, I don't think anyone should just own one asset class. I would not advise that anyone do that. It's not the end of the world if you do. At least 500 companies is decent, but it's still one asset class. So if you're diversified, there's going to be times where your performance differs. I mean, it's kind of obvious, right? If
Right.
you own different stuff, your performance is going to be
Right.
different. But people still make that apples to oranges comparison. And what happens is they can start to think that their portfolio is defective. So using the recent example, if you compared the performance of the Standard & Poor's 500 index to the Vanguard Total World Stock Index that includes international stocks, you're going to think that you made a bad decision. You're like, oh, why did I do this? I'm underperforming the Standard & Poor's 500 index. There's something wrong with what I'm doing. Maybe I need to make a change. And the answer is no. In fact, your portfolio, in my opinion, is better. It's more diversified. It has small companies. It has international. It's just objectively, I think it's a more defensible portfolio, more reasonable portfolio. But there can still be long periods of time, not just this year. There can
Right.
be periods of several years
Or
where
a decade.
global portfolio will underperform a benchmark. And that can, like I said, it can really make you second guess. But you need to make sure, like I said, if you own a global portfolio, either that you're comparing it to a globally diversified benchmark, or just recognize that you're not going to closely track the benchmarks you see on TV and be okay with that.
In other words, you in your blog, which by the way, you can go to ruediwealth.com to get the blog. And if you're on Facebook Live, I think Paul's going to attach that as well. I thought it was interesting, and you included a chart. I think this is one of our better blogs that was been written for Ruedi Wealth Management. There's two or three that stick out in my mind. This one certainly is one of those top three. And so so again, spoken like a true father, but I read it and I thought, wow, Dave, this is really good. You sure you wrote this? Anyway, You wrote since 1970. This is from a study done by Dimensional Fund Advisors when you used to work there. From 1970 to 2017, the S&P 500 did better than the global portfolio 19 times and worse 29 times. But you think about those 19 times that it wasn't, that the S&P 500 was better, it was better. And some of those, not only that, were longer periods of time. And that really goes to what you're talking about.
Right.
If you're going to be diversified, you're not buying a conventional benchmark, which by its very nature means that you have an unconventional portfolio. That's not a negative thing. It's just what it is. And because of that, you have to set your expectations differently. And I think that's what gets missed. I don't think people they don't align the expectations with their diversified strategy.
And I think people make decisions and draw conclusions on way too short of a time horizon. So they'll see 3, 4, 5 years of, quote, underperformance relative to a benchmark that they see on TV and think that tells them something about the future. It means that the S&P 500 has, it's a better investment than their global portfolio. And that's just way too short of a time horizon to draw any conclusion.
And that circles back to, and we're going to be done here in about 30 seconds, is when you really look at successful investors and investors that are not, it was usually a behavior problem that was the issue. It's not maintaining that faith, patience, and discipline to stay with the diversified strategy. Even when diversification works, even when you wish it wouldn't, it's still working because it's behaving differently. Maybe it's in a sense that you don't like, but it's behaving differently, which is what you're after. Well, Dr. Fred, thanks for joining us. And David and Ryan, thanks for joining us. For Paul Ruedi's On the Money, we'll be back in a couple of weeks. Thanks, everybody, for your calls today and text on the Castle Heating and Cooling text line. Thanks for listening.